Welcome back. I'm Steve. Look, today we're tearing straight into the absolute nuts and bolts of the violent market action we just witnessed. We're opening the ledger, breaking down the raw data, reading the tape, and figuring out exactly what this insane volatility actually means for your capital. No fluff here, just the hard numbers. Traders are finally back at their desks after the holiday pause, and this regular cash session just reopened with some serious, intense cross-asset volume. The market found a tentative lifeline today, and, well, we're going to figure out exactly who threw it. Let's get right to work.
Hit the brakes. 5%. Listen to me. Before we touch a single stock, you absolutely need to understand the massive structural shift happening in the bond market right now. The 30-year U.S. Treasury yield is remaining stubbornly high. It's hovering right past that crucial 5% mark for the very first time since 2007. And guys, this isn't just some blip on the radar. This is a heavy pressure valve on capital. Literally, it is the defining macro weight that dictates every single thing we're going to talk about today.
All right, let's just read the tape directly and see exactly where the major asset classes landed as all that cross-asset volume flooded back in. S&P futures, ticker $ES. They carried their weekend momentum straight into the closing bell, locking in a clear gain of 0.65% to settle out at 7,554.50. Spot gold, on the other hand, saw a pretty sharp intraday reversal, pulling back 1.16% to settle near $4,518. Bitcoin flushed right back below its upper bounds, printing at $75,959.10. But the real story here? Brent crude, ticker $BZ. The energy pick saw an aggressive trend reversal, jumping over 2% back up to 98.20. So, sure, the bulls stepped up in equities, but this movement absolutely didn't happen in a vacuum.
To understand the true structural driver of today's tape, we really have to talk about that yield pressure valve letting off steam. Think about it. When you have risk-free government bonds paying north of 5%, it aggressively compresses the equity risk premium. Put simply, investors are being paid significantly less to take on stock market risk. That makes the S&P 500 highly vulnerable to a sharp valuation correction, even with this recent tech-led earnings hot streak we've seen. If these yields don't cool off, the sheer weight of these borrowing costs is eventually going to override the paper momentum we saw today in equities. Mark my words.
Now, you can't trade the numbers without understanding the real-world catalyst. And right now, we've got to look at the physical friction points over in the Gulf. Any of that brief paper market selling we saw based on those premature rumors of a 30-day framework deal, yeah, that completely evaporated overnight. U.S. military strikes against Iranian targets inside the region just dashed all hopes for a quick diplomatic end to this 3-month-old Gulf conflict. The geopolitical friction is very, very real, and it is actively driving the tape right now.
Let's break down the physical realities on the ground because honestly, they're locked in. We're looking at heavy restrictions in the Strait of Hormuz, which is leading straight to an unsustainable draining of global oil inventories. The market completely bought that reality today, which is exactly why Brent crude pushed back toward the upper 90s. And here's the crucial connection you need to make. This creates sticky energy inflation. That inflation is exactly what keeps forcing interest rates higher, keeping those treasury yields firmly pinned at that 5% mark we talked about just a minute ago. It's a vicious cycle, plain and simple.
So this complex mix of soaring yields and escalating geopolitical tension, it sets up a brutal, high-stakes battlefield. On one side, you've got the bulls. They're banking on corporate earnings resilience and price momentum. They're basically betting that big tech cash flows can power the index straight through this tightening cycle, leaning heavily on near-term moving average support. But on the flip side, the bears are warning that this is a massive bull trap wrapped inside a structural stagflation cycle. They're pointing straight at that 5% yield compression and the high consumer costs, arguing that just one more diplomatic breakdown is going to skyrocket energy prices and completely wipe out today's equity buyers.
So how do we actually trade this structure without letting a single green candle make us sloppy? Well, here are the cold, hard directives. On the S&P side, futures are holding right above the daily 20-day simple moving average at 75.50. It's definitely showing some strength there. But pivoting over to Brent crude, it's sliced clean through its daily 20 SMA and is testing directly on its 50-day exponential moving average at that $95 shelf. This divergence right here, this is exactly what you have to trade.
Let's drill down into these specific levels. Get your pens ready. Here's your playbook. Step 1. Watch the ES50 EMA curling up near 7,410. That is our primary line in the sand. As long as price stays above it, the intermediate uptrend is protected. Step 2. You absolutely must watch the Brent crude 50 EMA at $95. If Brent fails to hold that level on a closing basis, man, the doors swing wide open for a much deeper retest of the long-term 200-day SMA. Keep your eyes glued to these moving averages and trade the actual numbers right in front of you.
If you want to know what the ultimate smart money is doing while everyone else is out there chasing intraday ticks, look no further than Berkshire Hathaway's playbook. Ajit Jain made it incredibly clear. Berkshire has its price locked in to underwrite the marine war risk, but they utterly refuse to front-run rumors. While other insurers are out there panicking, Berkshire is holding the line. They're sitting on massive cash reserves, just waiting for the market to price the risk on their terms. It is an absolute masterclass in veteran discipline and capital preservation. They're just collecting guaranteed risk-free returns and waiting for the heavy macro weight to break the weak hands.
Remember this, sometimes doing absolutely nothing is the most aggressive trade you can make. The ledger doesn't wait for latecomers, guys. Use small sizes. Keep your stops tight. So, knowing the geopolitical powder keg we're sitting on and those immense yield pressures we just mapped out, are you ready for the morning bell? Stay disciplined out there. I'll see you next time.